Let's bring in Julian Emanuel. He's the senior managing director at Evercore. Do you think that's true, Julian, or do you think there are those who look back to April and say that was the buying opportunity of a lifetime?
Well, you have to separate the two. Clearly, what happened, if you go back to April, is that there was a policy pivot. The president, if anything, over the course of this first year of his administration, has proved very sensitive to taking in the concept of the market as a voting machine on his policies. And when you saw stocks down basically 20% in April, that's when the policy pivot began. You look at the setup right now, and there's nowhere near that kind of stress. In fact, I would argue, given the fact that you have a second day of losses in Europe, that this decline is reasonably contained and volatility is reasonably contained. So from that perspective, we'll have to wait and see. But it doesn't look like he's moved away yet from escalation mode.
Right. So, it also, by doing this many media appearances, it's obvious he's not trying to. Back then, it was tariffs that he was, excited to introduce to the world. And ultimately, as you say, when we kind of look through the end of the year, $30 billion a month is the run rate. So they stayed in place, but not to a huge extent, maybe enough to help on the deficit, but not enough that it derailed the markets, as you said. Game out the Greenland situation for us here. What is it that specifically the global markets are responding to today? Is it fragmentation? Is it a sell U.S. trade? What do you think the precise concern is?
Well, the first thing we have to understand is that the first 2 weeks of 2026 were unique in that literally every measure of risk and volatility across assets was at or near post-pandemic lows, which, given the fact that you had already had the incursions into Venezuela, given the fact that the Supreme Court has a ruling ahead of it, a potential government shutdown, et cetera, it was a surprise in the first place. But when you look at the events over the weekend, if you're Europe in particular, there's certainly concern about the deconstruction of the global order vis-a-vis NATO, and then the reality of Europe having a theater of conflict on its eastern flank vis-a-vis Ukraine and Russia, and now all of a sudden, prospectively, on its western flank in Greenland. And, there's plenty of reason for concern.
Although the last time I checked, let's see, the Euro stocks was down 0.7% today. This was up 4% to start the year. So European equities have been a tremendous investment throughout all of this. I'm also curious if we can put the defense stocks on the screen a little bit. There's the ITA ETF, but there's a few others. There's kind of two schools of thought about this, Julian. One is that obviously anything that causes fragmentation or an arms race would be positive for U.S. defense names. They're down 2%. The other issue, and perhaps explaining this decline today, is they sell a lot to Europe. We do a lot of business with European buyers. And so if they are going to back off of that, either as a, response to what the president is doing, or literally because it would no longer make sense and they want to look, more internally or for other suppliers, there's the pressure on the defense sector, which has been one of the best performers in this market.
Well, and what we've seen over the course of the last year is it's less about the imposition of tariffs and the tariff regime itself and more about the threat to the free flow of goods and services that is exchanged every moment of every day. And I think that is why there is concern about this potential for the February 1st 10% deadline, and then subsequently the potential for the June 1st 25% deadline, and the idea that Europe is poised to retaliate.